Hey guys, it's Brenna, the CEO and founder of the Mortgage Shop, coming to you today to talk about tax returns with Ryan Bakke and the benefits to hiring a real estate CPA and also somebody that invests in real estate. So Ryan also invests in real estate. So not only is he a CPA, he kind of knows what you guys will be going through or what you have gone through with previous returns and maybe filing on your own versus hiring a CPA. So I wanted to go through a bunch of that with him today and bring to you. Hi, Ryan.
Hello.
How's it going?
I'm doing good today. It's the end of the week. Ready. I don't even really have anything planned this weekend. Probably just going to relax a little bit. I'm going to Miami next weekend for a mastermind that I'm in. It'll be my first time in Miami, so I'm super excited and preparing for that.
There's a really good Italian restaurant there that I'll tell you about later. But anywho, sidetracking. So can you explain to us like the benefits of owning short-term rentals? Because the thing with short-term rentals are people get caught up on the bottom line, right? So I always see like, well, I want to net this much a month or this much a year. And they don't know the actual tax benefits that they can get from that. So explain things like, you can claim amortization or depreciation or something like that. So can you explain the benefits of owning short-term rentals as opposed to not just looking at the bottom line per month?
Yeah, so I like short-term rentals specifically for multiple reasons other than just tax, but let's be honest, there's more cash flow to be had with short-term rentals as long as you're buying in the right markets with the right demand, et cetera. In my opinion, there's better financing options for short-term rentals. Like when I went out and started buying long-term rentals, I noticed, most of the time I had to put 20 or 25% down because it was an investment loan. And there's worse terms where, people, and correct me if I'm wrong, but people still have the potential to buy short-term rentals using a 10% down secondary home loan or getting in for 10 or 15% down as opposed to the 20 to 25% that you would need with a long-term rental.
They can if
Is that
they
correct?
intend to vacation there, primarily. So you can get into it if the 10% down, like second home loan, if your main intent is to vacation there first. So definitely, because I've seen a lot of clients grow, with knowing the area. Once they get that second home, then they may want to rent it out at some point and then build
Mhm.
their investment portfolio from there. So yeah, that's definitely a good idea if you're wanting to use it as a vacation home.
Right.
Um,
But the best benefit by far is the way that short-term rentals are treated differently than long-term rentals when it comes to taxation. So, for example, if I own a long-term rental or apartment building or multifamily house and I have a solid W-2 income, let's say I make $250,000. I'm not able to take the tax benefits of depreciation, having a loss, and use that to offset my W-2 or my business income if all I have is long-term rentals. I have to be what's known as a real estate professional in order to do that. And so a real estate professional is somebody who spends all their working time in real estate. And so for most, nurses, doctors, attorneys, people that work in tech, they're not going to be able to meet those requirements of being able to take a long-term rental loss against their W-2 or their business income. Where short-term rentals are different is you don't need to be a real estate professional and you don't need to meet these huge hours requirements in order to take a loss against your W-2. And when I mean loss, it's a blanket statement. These are not cash flow losses. These are tax losses. So my net operating income, when I show net operating income, either on my tax return or from my books, is going to be positive. There's cash that's going to hit my bank account. But because of depreciation and the tax benefits, I'm able to turn around and tell the IRS that I actually have a loss. Okay. And then with that loss, if I have short-term rentals and I meet certain requirements that I've talked about before in my podcast and my blog and my content on YouTube, I'm able to take the loss against my W-2. And it's huge when it comes to accelerating wealth building. To give you an example, that same single guy that's in the $250,000 income, he's in a 32% tax bracket. Okay, well, if I'm able to generate $100,000 loss on my short-term rental, let's say I bought a cabin for 500 grand and I can generate $100,000 loss from that. I'm able to save 30 grand, $32,000 in taxes by buying that short-term rental and applying tax strategy to it. I'm not able to do that with long-term rentals and apartment buildings. There's tax benefits to be had. Any real estate that you buy and own, buy and own that you own yourself, not arbitrage, not co-hosting, but any real estate that you own, there's tax benefits too, but there's more tax benefits if you buy short-term rentals and you're the one that's actually managing them too.
Yeah, definitely. Because I see like a lot of people, since the interest rates have increased for right now, people are just looking at, well, I want this to be my cash on cash return, or I want this to be my bottom number per month. And they get caught up in that when they don't realize, okay, let's talk with a real estate CPA to see my benefits from a filing standard. And, rates aren't going to stay up for the next 30 years. It ebbs and flows, right, with the economy. And so it's going to go down. So it's like, is this a benefit other places as opposed to just that interest rate? And so that's what I wanted to kind of cover with that. So if you guys are doing this for the first time and you have never gotten a rental property before, usually people, if it's in your personal name, you will file that rental income on your tax return on a form that's called the Schedule E. And that does things like your rental income. It also can show things like oil royalties, trust income, things like that. But most of the time, it's for that rental income on the Schedule E, page 1. So explain how the difference between filing rental income on your Schedule E, or as we did a video last week about closing in an LLC, the differences between that and then closing in like a partnership return with the real estate being under that return as opposed to on the Schedule E on your personal return.
So I'll do it from order of simple to more complex. So the simplest way to do it is to have it in your personal name, close on the property in your personal name, the title and the loan is in your personal name. That's going to get reported on your Schedule E. And now there's a lot of people that will say, oh, short-term rentals should go on your Schedule C. And the answer to that question is actually the only time a short-term rental will go on your Schedule C instead of Schedule E is if you provide what are called substantial services for your guest. So if you hire somebody to cook, somebody to clean while your guests are staying there, somebody to take out the trash while your guests are staying there, then the property goes on Schedule C. C? Yeah, C.
You got another word, yeah.
But 90% of short-term rental investor owners, their short-term rental is going to get reported on Schedule E. Okay, so if it's in your personal name, it goes on Schedule E. If the property is in a single member LLC, the loan's titled in a single member LLC, the house is titled in a single member, the loan is in a single member LLC, that property still gets reported on your Schedule E of your tax return. Okay, just as if you think of it if your LLC didn't exist. Now, you're going to have some paperwork with the state, some filing fees with the state. You might have a state tax return to file. So like California, Texas, Tennessee are the three that kind of stick out to me, where if you have a single member LLC, even though you don't have to really do anything complicated from the federal level, you're still going to have to file and pay some sort of state tax or state tax filing fee. So we like it in a single member LLC. That's fine. Where it gets complicated is the multi-member LLC or a partnership, because, and this is what I saw a lot of people last year kind of make this mistake. Let's say you got a husband and wife, or you got a boyfriend, girlfriend, you got two partners, and they close on a property inside of a multi-member LLC. Anytime an LLC has more than one member, it's automatically taxed as a partnership. Okay, and a partnership, the reason why a partnership is different is because, well, first, it files its own tax return. It's not like you just report it on your individual. It files its own tax return, and also it's due on March 15th, not April 15th. And a lot of people miss that. So if let's say you and I own a short-term rental together, we're going to file a partnership tax return with the IRS on March 15th. We'll also file a partnership return at our state level too, if we have a state with income tax, right? That partnership will give us what's called a Form K-1. And the Form K-1 is just a summary of your share of the partnership. So let's say we bought a short-term rental and we made 50 grand total, and we're 50-50 owners. You would get a K-1 saying that you had 25 grand of rental income, and I would get a K-1 saying that I had 25 grand of rental income. We then would report those K-1s on our own individual tax return. So even if it's a husband and wife owning an LLC, there could be that multiple layer there of, hey, you have to file an extra return, which means you have more filing fees. It gets more complicated, and lenders oftentimes, they want to see it flushed out really simple on your Schedule E. They don't want to see just the K1, because the K1, if you just have the K1, all it shows is your income. It doesn't show the expenses of the partnership of the rental property.
Mhm. Yeah, and that's why I want to plug right now. Like, it's very important when you're getting into this, guys, to hire not just a CPA, but somebody, real estate CPA, that knows how to file real estate income. Because as he was explaining, he said, sometimes there's different schedules on your personal tax return. It can be a Schedule C for a sole proprietorship or Schedule E for rental income. And sometimes I see these CPAs file it on a Schedule C, and it kind of screws the borrower over because it's not supposed to be on the Schedule C. They're not offering any of these additional services. They don't have a maid or a cook at the house. It's a normal short-term rental that needs to be filed on a Schedule E. But if your CPA isn't familiar with that, they're going to think, well, you offer services like linens and towels and soap, then you have to put it on a Schedule C. Like, it's not that convoluted. And so that's why I always say, like, please hire a real estate or a CPA that specializes in real estate. Also, when we're talking about a separate return, so once you add somebody into the mix, it's a partnership or what have you, or however many people you add in, it becomes a separate business return. Like you said, not on your personal tax return. Now you're going to have a set of 2 tax returns, your personal and business. And then some people will want to put one property in one LLC and maybe another property in a separate LLC. And so this is where it gets a little squirrely, guys. If you're just starting out in this isn't really for you. But if you are somebody that does have multiple properties and you're thinking about separate LLCs to protect certain assets, then can you explain, Ryan, how you can have multiple LLCs flowing through one tax return? I know it's going to be different for everybody, and this is not advice that covers like a cloud, because every person's business is going to be different. But explain how there can be multiple properties in this partnership.
Yeah, so ideally, you could have an LLC for each property. If it's a single member LLC for each property, those are all going to flow to you on your Schedule E. That's the most convenient, that's the most quickest, and that oftentimes is the best route to go for income qualification purposes and future loans. Because it's not just about like what happened this year, but it's about your ability to be able to make sure your DTI is in check, to make sure that you prove that you're a short-term rental host. I remember like when DSCR loans for short-term rental investors first started coming on, they were giving them to anybody. Now some of them are like, hey, you need to have a year or two of short-term rental experience in order to get them. And if you're not filing your returns correctly, you might miss something that's going to put you out of the game for a year. Or at worst case, you're going to have to pay an extra % or 2 to maybe do like a bank statement loan or some other sort of financing. You can have a partnership own multiple LLCs that all flow into the partnership. It's really complicated, and I don't want to show it on air, but all those single member LLCs can be owned by the one partnership. So let's say you and I own a partnership together. We could have properties in different states, and those all could have single member LLCs that are owned by our one partnership. So at the end of the day, there's only one tax return due for our entire entity structure. I could draw it out right now if you want me to show you.
No, I think we're good.
Okay.
Because
so
I think it's just like a high level basically of like how you can have multiple LLCs, that it can be one partnership still. I think people get confused and they're like, well, it's a different LLC, so I have to file a separate return for each, even though they have the same partner. And so I just wanted to clarify, no, that's not how you have to do it. Obviously Schedule E on your personal return is the easiest cut and dry thing to do. Now, I do want to let the viewers know, if you are listening to this for qualification purposes on our end, on the mortgage end, what I have seen, we talked about some people will file that on a Schedule C instead of E because there's additional services. Well, they're working with the CPA that doesn't necessarily know the short-term rental world. And let's say for 2020, they filed that property on their Schedule E. Then for 2021, their CPA is like, oh, it's a short-term rental. We have to file this on a Schedule C. Schedule E, guys, is the only tax return form that we only need 1 year of if you're wanting to use rental income. most of the time, unless you've owned your business for 5 or more years, we have to have 2 years tax returns. So that CPA from Schedule E to Schedule C, now that Schedule C is known as self-employed business. And
Good
now
point.
that borrower has to wait 2 years to use that income. And guess what? That mortgage is still counted against them in their personal name. So that's why I wanted to make a really big point of, please do your homework and don't just hire anybody to do your tax return, because you want them to look at your long-term goals so you're prepared and for the next year coming up, so you can show what you need to on your tax return and still qualify for more real estate in your portfolio.
Yeah, I would even take it a step back to even before you go into setting up your entity structure, what is your plan, right? Because if you and let's say a spouse go and form an LLC, well, that's automatically a partnership return, which means it's a business tax return filing as a business as opposed to you as an individual. That can make it harder for you to qualify for another loan in the future. Am I right?
Yeah. Yeah, I mean, it's like it's all in the way you file it, because it's just hard to explain. Like, you have to have 2 years of mostly everything. But Schedule E is the only thing that you only have to have 1 year of for rental income. And
Mm,
so I just see a lot of people mess up, and then they kind of screw themselves over, and they may have to do that DSCR loan because their debt to income can't hold it because of the way they filed certain things on their tax return, or didn't file on their tax returns and should have put here instead of here. So just do your homework up front. Watch that LLC video I did to look into, because it's not, again, it's not just setting up an entity wherever you want. There's some rules for different states of wherever you're investing in. So not to get into all of that again, but just do your homework first. Talk to somebody like Ryan when you're ready to go forward and be like, all right, I want to structure how we're going to file my tax return. Let's pretend that you're talking to Ryan at the end of this year going into 2023 and say, okay, for 2023, I want to structure it where I can expand my portfolio as quickly as possible. These residences are in my personal name. It's just, it's not a partnership. Then Ryan's going to talk to you and educate you. Okay, it needs to be this. And for your specific benefit, this is the way it could go. Or if you already have a real estate attorney, talk to whoever that knows what they're
mhm.
doing in this, and not just a CPA that you Googled and hope for the best.
Another thing I wanted to go back to is oftentimes, I've heard this, and I'm sure you've heard this too. There's lenders out there that will actually advise and tell people that they should leave off certain expenses on their tax return in order to boost their income so that they can qualify for loans. From the IRS's perspective and the state's perspective, if you have an expense in your business that money is actually left your account, you have to claim it on your tax return somewhere. You don't just get to decide that you can leave off this expense because you want to show income and then go back and amend your tax returns. That's blatant fraud, actually. So every single expense that comes out of your account for your rental property has to be taken in some sort of fashion. But what I wanted to emphasize is that there's some expenses that you take that can get added back to your income for loan purposes. And so even though you come out of pocket for some of these expenses, it still gets added back so it doesn't go against you. Can you elaborate? I know Fannie and Freddie have underwriting guidelines for which expenses get added back, but which ones do you often see get added back for the most part?
Depreciation, amortization, if any, and mortgage interest. Like, well, it shows this on here, on my tax return, and then we kind of be like, no, you can actually add this back in, and all of that stuff. I also wanted, while I'm thinking about it, calculation of Schedule E, we really need those days that it was rented shown on
Good point. Yeah.
Schedule E. Because if it says 0, I've seen some people like it was rented out the whole year and their CPA put 0. You can't, you have to have
Mm.
those days put in there, usually 365. Sometimes you'll see 366, which means it's a leap year. I just wanted to throw that out because it just reminded me of that.
Also, too, so let me plug that. The total fair market days is not the amount of days that you've had it listed for rent, but it's the actual amount of days that you rented it out. So
Yes.
if you know, let's say you set yours up in October, you had October, November, December, so that's 100, that's 90 days total. It's however many days you actually rented out the property. So maybe out of those 90, you only rented it out 67 or 68. That's what would go in the fair. So there's two boxes. There's fair rental days, and then there's a personal use day. And I wanted to draw emphasis to this because there's two hands. You got your left hand and the right hand. The left hand is what the IRS wants you to do. So the IRS is saying like, hey, if you use that property for more than 14 days, personal use, we're going to have some problems because they're not going to let you deduct expenses at a business level if you also got some sort of personal use benefit to that. So the left hand is saying, the IRS says, hey, we don't really want you to use it for more than 14 days. If you use it for more than 14 days, then we're going to start counting some of those expenses against you and not let you take them. My other point of that is if you're at the property and you work for at least 4 hours a day, it does not count as a personal use day against you. So I wanted to throw that out there too. The right hand, though, is if you're buying the property as a secondary home loan, the lender is going to want to see that you're actually you're using it as a personal use requirement. And oftentimes they want you to use it for 14 days. And so in my tax organizer that I will send out to clients when we get their tax returns filed is, how many days did you use it for personal use? And I want to make sure that they're touching both bases, that they're meeting their lender's requirements and they're also meeting the IRS requirements. Because if you go in there and put, oh, I didn't use it at all, and then you probably wouldn't be able to go back to that same bank for your next home loan.
Right.
Am I wrong? Am I right?
No, I mean, yeah, definitely. And so that's why I always say the happy medium. Somebody's like, well, how long, do I have to stay there? And I'm like, 14 days, like just 14 days down the middle to appease everybody and their mom in this business.
Mm-hmm. Cool.
I think that's all I had for Schedule E. I actually didn't know about the 4 hours. I thought it was like the whole time, like 5 to 8 hours or something like that. So I didn't know that. That's a cool little tidbit to have.
Yeah. So for my understanding, and a lot of this is kind of newer just because short-term rentals really just start taking off in, I would say, 2015, 2016. But all the work and the time that you spend there before the property goes live is not going to count against you as a personal use day. It's okay, once that property is placed into service and you actually start renting it out, you have 14 days of personal use there. And then again, if you're working there for at least 4 hours, it doesn't count against you as a personal use day.
Nice. Okay. Good to know.
Weekends, weekdays, doesn't matter. It's still a personal use day, by the way.
And now I've kind of said I think all the benefits to hiring a CPA because I've harped on it, but in your experience, looking from the outside in, what are the benefits of hiring a CPA that specializes in real estate and knows what they're talking about in that avenue?
To me, it's like making sure your shoes are tied right before you begin the race. So a lot of times people will jump into this space, they have the capital, they have the knowledge, but they go in thinking, oh, I don't need an attorney. I could use that. I could do that on LegalZoom. I don't need an accountant. I'm just going to go look up some forum or some Facebook group. If you're getting your information from my Facebook group, that's one thing. But if you're just getting it like from people on some of these real estate forums, just buyer beware, be careful, right? So I think it's not surrounding yourself with the right sort of team to help propel you into the future. Because like what we mentioned before, if you do something like that wrong, where your husband and wife set up an LLC and now it's a business entity, and you have to file a business tax return for that, and it's not going to hit your personal income, it's gonna make you have to wait a year or two to get another loan. Like that could be crushing. And it's something as simple as that. That's an easy. I mean, I can explain entity structure, not too in depth, but I could probably explain it within 15 minutes to somebody. Like what is your goal? Here's probably how you should set it up. Here's why you should set it up. Pros and cons to both. So that's one thing too. And I think second, more importantly, is like working proactively and not reactively with somebody. Because if all you do is, okay, let's say this 2022 is over and it's February or March of 2023, and you take your stuff to somebody, to be quite honest with you, there's not much that they can do at that point because the year is already over. The calendar year, the tax year exists from January 1st until December 31st. And so it's only those things that you do in that amount of time that are going to help or hurt you. You could take your return to somebody to get it filed to make sure that you're not paying more than you need to. But if you actually want that planning, that planning and preparing for what your tax liability is going to be, you need to hire somebody that's going to work with you right now throughout the year.
Yeah.
I've seen, I've probably talked to 3 or 4 people in the last month or two where they had a really good year. Like their income was, maybe their income went up 1.5 or doubled. They bought rental properties, and next thing you know, like they're going to buy another property, and then they find out that they have a $35,000 or $40,000 tax bill because they made a ton of money. And then it's like, hey, you got to wait till after you close on that property to pay that tax bill.
Cool. And then I wanted to ask, you are currently taking on new clients, right?
Yeah, so I could drop the link. We have you fill out a short survey. It'll route you to a consulting call with either me or one of our team members, and we'll ask some questions, make sure we're a good fit. We do a preliminary analysis to make sure that it's a good fit. If I don't think we could save you 5x of what we cost, then we won't even take you on as a client. We would most likely refer you to somebody else, another real estate CPA.
Thank you so much for joining us. And I know I'm going to get the question, what states do you cover? So can you let everybody know that?
Yeah, so we do tax strategy for all states, and we do tax filing for all states except Hawaii. If you're in Hawaii, I'm sorry, unfortunately. If you are resident, if you're investing in Hawaii, but if you're a resident of Hawaii, we can't at this point in time.
Yeah. And I do want to say, like, everything that we are talking about today on this video, it's not personal tax advice for you personally. This is just what we have seen over the years being in this profession and knowing what works most of the time, what doesn't work, what should happen most of the time. So always get advice on your personal situation, because you could be totally different than your neighbor or whomever. So always get advice personally for yourself. But besides that, thank you so much, Ryan, for joining me today, and I will talk to you guys soon.
Yeah. Thanks, everyone. Bye, everyone.